A personal loan can be a helpful tool for various needs, from consolidating debt to funding a dream vacation. But how does taking out a personal loan affect your credit score, that all-important 3-digit number that can influence everything from loan approvals to interest rates? Let's break it down. Personal loans can be a tempting financial tool, offering a quick influx of cash for various needs, from consolidating high-interest debt to funding a dream renovation or unexpected medical expense. But before you dive into the world of personal loans, it's crucial to understand how they can impact your credit score, that 3-digit number that holds significant power in your financial life. A personal loan can be a double-edged sword, potentially boosting your score or causing a temporary dip depending on how it's managed. Let's break down the different ways personal loans can affect your credit score: the short-term dip, hard inquiries, and the credit mix. The application process for a personal loan typically involves a hard inquiry on your credit report. This inquiry is essentially a record of a lender requesting your credit history to assess your eligibility for the loan. While a single hard inquiry won't significantly damage your score, it can cause a temporary dip of a few points. This is because multiple hard inquiries in a short period can signal to lenders that you might be applying for too much credit at once, potentially increasing your risk of becoming overextended. The good news is that the impact of hard inquiries fades over time, usually disappearing from your credit report entirely within 2 years. However, there's a positive aspect to consider here. Your credit score takes into account your credit mix, which refers to the variety of credit accounts you hold. Having a healthy mix that includes installment loans like personal loans, alongside credit cards and mortgages, if applicable, demonstrates to lenders that you can responsibly manage different types of credit. So, while the initial hard inquiry might cause a short-term dip, the presence of a personal loan in your credit mix can eventually benefit your score in the long run. The long-term impact: credit utilization ratio and payment history. The two most significant factors influencing your credit score are your credit utilization ratio and your payment history. Here's where responsible personal loan management comes into play. A credit utilization ratio. This ratio compares your credit card balances to your total credit limits. When you take out a personal loan, it increases your overall debt and can affect your credit utilization ratio. Here's the key: maintaining a low credit utilization ratio, ideally below 30%, is crucial for a healthy credit score. Let's say you have a total credit limit of $10,000 across all your credit cards, and your current balance is $2,000, giving you a utilization ratio of 20%. If you take out a $5,000 personal loan, your total debt increases and your credit utilization ratio jumps to 70%, assuming you haven't paid down your credit cards. This sudden increase can negatively impact your score. A payment history. This is the single most important factor influencing your credit score. Making consistent and on-time payments on your loan is vital for building a good credit history. Every on-time payment you make is reported to the credit bureaus and strengthens your creditworthiness in the eyes of lenders. Conversely, missing even one payment can significantly damage your score and take a long time to recover from. Personal loans can be a double-edged sword when it comes to your credit score. Managed responsibly, they can become a powerful tool to build credit history, consolidate high-interest debt, and ultimately improve your overall financial health. However, neglecting strategic planning and responsible management can lead to a negative impact on your score. Here's a detailed breakdown of how to leverage personal loans strategically for credit score improvement. 1. Debt consolidation. A powerful tool for weighted improvement. The burden of high-interest debt. If you're struggling with high-interest credit card debt, you're not alone. Credit cards often come with hefty APRs, annual percentage rates, that can trap you in a cycle of minimum payments and accruing interest. This can significantly strain your budget and negatively affect your credit utilization ratio, a key factor influencing your credit score. The power of consolidation. A personal loan can be a strategic weapon in this battle. By consolidating your high-interest credit card debt into a single personal loan with a lower interest rate, you can achieve several benefits. A reduced interest payments. The lower interest rate of the personal loan frees up money you were previously paying towards high-interest charges. This allows you to focus on paying down the principal amount faster, accelerating your debt repayment journey. Simplified debt management. Consolidating multiple credit card debts into one personal loan simplifies your debt management process. You'll have one monthly payment to focus on, making it easier to track your progress and stay on top of your repayments. Improved credit utilization ratio. As you pay down the personal loan and your credit card balances decrease, your credit utilization ratio improves. Remember, ideally, you want this ratio to be below 30% for a healthy credit score. Consolidation helps you achieve this by reducing your overall credit card debt. 2. Building credit history. A stepping stone for future opportunities. The challenge of limited credit history. If you're new to the world of credit, establishing a positive credit history can be challenging. Without a track record of responsible credit management, lenders might be hesitant to offer you loans or favorable interest rates. The strategic use of personal loans. A personal loan can act as a stepping stone in building your credit history. Here's how to use it strategically. Borrow responsibly. Only borrow what you can comfortably afford to repay on time. Don't get caught in the trap of overextending yourself and potentially missing payments, which can severely damage your credit score. Focus on on-time payments. This is crucial. Every on-time payment you make on your loan is reported to the credit bureaus and contributes positively to your credit history. Consistent on-time payments demonstrate your reliability in managing debt, which is a key factor lenders consider when evaluating your creditworthiness. You consider a cosigner. If needed, if you have limited credit history or a poor credit score, having a cosigner with a good credit history can improve your chances of getting approved for a personal loan with a favorable interest rate. However, remember that cosigning comes with responsibility. If you miss payments, it can negatively impact your cosigner's credit score as well. 3. Strategic borrowing for specific needs. Building a positive credit mix. The importance of credit mix. Your credit mix refers to the variety of credit accounts you hold. A healthy mix that includes installment loans like personal loans, alongside credit cards and mortgages, if applicable, demonstrates to lenders that you can responsibly manage different types of credit. A strategic borrowing for specific needs. Consider using a personal loan for specific needs that can also benefit your credit score in the long run. Here are some examples. Home improvement projects. Financing home improvement projects with a personal loan can increase your property value, potentially giving you equity you can leverage in the future. Additionally, making on-time payments on the loan contributes positively to your credit history. Educational expenses. A personal loan can help bridge the gap in financing your education. Responsible management and on-time payments not only improve your knowledge and skills but also contribute to a positive credit history. Remember, strategic personal loan usage requires careful planning and responsible management. Here are some key takeaways to keep in mind. Know your credit score. Before applying for a personal loan, understand your current credit score. This will help you determine your eligibility for different loan options and secure the best possible interest rate. Compare loan options. Don't settle for the first offer you receive. Shop around and compare interest rates, terms, and conditions from multiple lenders to find the deal that best suits your needs and budget. Remember, a personal loan is a financial tool, and like any tool, it needs to be used responsibly. Here are some key takeaways. Shop around. Compare interest rates and terms from different lenders to find the best deal. Borrow only what you need. Don't overextend yourself with a loan you can't afford to repay. Make your payments on time. This is crucial for building a good credit history and avoiding negative impacts on your score. By understanding the impact of personal loans on your credit score and using them strategically, you can leverage them as a tool to improve your overall financial health. Have you used personal loans to manage your finances? Share your experiences in the comments below. If you have any questions about personal loans or credit scores, leave a comment and I'll do my best to help. Don't forget to like this video and subscribe to the channel for more personal finance tips and tricks. Remember, knowledge is power, so let's work together to build a strong financial future.